let's move on from there and let's welcome on board Dipan Mehta, the director at Elixir Equities. We also have Kapil Shah, the technical analyst at MK Global Financial Services, joining us on the show. Good afternoon to both of you and thanks for joining us. Dipan, I'm going to come to you first and I want your view on the overall market, yes, of course, but select packs in the market today are once again gaining some steam, the likes of railway, you have defense. These are themes that had seen a run up, then cooled off for a bit, and they have started spiking again today. Do you believe that this is the beginning of another leg of spikes, or do you believe today is just a one-off?
Good afternoon, and thank you for having me on your show. No, I think that it's a continuation of the momentum which we have seen in these companies over the past few weeks or so. And if you analyze the entire earnings season, the best sector has been defense, not as much railways, but defense certainly has come out with flying colors. And that is why investors are getting focused over there. And a lot of momentum trading also is taking place over there. A lot of retail traders also have entered these counters. But I think the valuations are a bit stretched at this point of time. No doubt the sector had a great quarter this time, but there are always execution challenges. And if you go back into history, there's a lot of lumpiness in their earnings, which is not completely discounted in the valuation ratios. So I think if you're invested in defense, I would remain invested. But from a fresh investment perspective, to me, it's an avoid. Railways, I'm not sure. I think they are going up in sympathy with defense, hoping that government expenditure will pick up over there. We don't know that for sure because last 3 years railway expenditure in the budget has been pretty much stable at around 2.5 lakh crores or so. And over there also, despite a steep correction, 30 to 50% correction in railway stocks, I think they are still quite expensive. And some of the bigger ones over there, like say Titagar wagons, came with a very disappointing set of numbers as well. So I would avoid both sectors from a fresh investment perspective. But look, there's great long-term visibility, and if you're an investor with a long-term view, you may remain invested.
Hi, afternoon. The big wave or the fad in the market right now is promoter exits, and that too at steep discounts in some cases amid the rich valuations. Just so many block deals pretty much on a daily basis, and some even FII and FDI driven. What is that smacking of, Dipan? And should one now warrant caution in the markets? Is it smacking of peak valuations by any chance?
See, I think this is we have seen this play out in the past also in the early half of 2024, right up to September 24, and then we saw a correction after that. So the minute starts, the market starts to do well and valuations get steep. We are seeing promoter selling, we are seeing private equity selling, and that all has been absorbed by retail investors either directly or through mutual funds. It's not reached the peaks which we saw in 2024, but certainly the trend is getting more and more accentuated. So yes, I think it's a signal that markets are kind of the expensive zone. And in my opinion, if you ask me, there are less uncertainties now than a few months ago, with the exception of Trump. And we do have a supportive Reserve Bank and a lot of favorable macro factors as well. But this earnings season, one thing is very clear that it's been very selective. And I suspect the next few months will be very selective for the markets as well. So I think that wherever there are pockets of overvaluation, you will continue to see supply. And this clearly is going to be a very challenging time for the investors, and not like what we saw, last 3, 4 years up to September 24, where entire market rallied. I think the entire trend is going to get very, very narrow, and it's going to be a bit difficult to charter for the novice investors.
Okay, so that's the take on all of the block deals that we've seen today and promoter exits coming in. But Kapil, also weigh in on the market here. Give us a sense of where you are seeing the market headed, and particularly India VIX, right? A steep cool off is what we've seen. Where do you see India VIX headed from these levels? Because the market, although range bound, seems to be stable for now.
Right. Good afternoon. So first of all, looking at the market, we have been seeing that from past 17 trading sessions, the market has been trading in the range on the higher side 25,100 level, on the lower side 25,500 level, and the middle point as like a 24,800 is acting as a resistance. So in a very short term of phases, yes, as far as the market is below the 24,800 level, it is in a minute negative development. But once market starts to move below a 24,500 level, then there will be some sorts of a incremental negative move that that we can expect. And then below that particular point, we may see that the market is heading towards a 24,000 level or 23,800 level. That is what my expectancy. As far as the VIX is concerned, yes, there is a very sharp cool off has happened from all the way 22 level to right now it is trading at a near about by 15 level. Now, historically, 15 level has acted as in a kind of a good support level where we have seen the reversal into the VIX on the higher side. However, at this particular point, there is no reversal, but this is a good support level. So we see that okay, if the VIX is rising from this level and market is breaching the 24,500 level, there can be some sorts of bearish scenario can be pictured.
Right, okay, that's the take coming in the market right now. Just looking at some of the active performers and look at Sun Pharma and Spark. The clinical trials have failed for psoriasis as well as atopic dermatitis, and that's why you're seeing such a crack come in on Sun Pharma right now. Although it's recovered ground from the session lows, at one point in time it was deep in the red, but Spark is the one which is badly impacted. Other than that, of course, ABFRL, the 10.5% equates to the block deal that happened on ABFRL. I remember 600 crore rupees of Flipkart actually selling stake in ABFRL, and that's why that quantum of a cut coming in for ABFRL. For Alchem, it's an 825 crore rupee promoter selling. For Tata Technologies, 635 crore rupees TPG Rise selling. And for Indegene, it's a sizable 1400 crore rupees, wherein Carlyle is actually offloading stake in Indegene. And these are the bunch of block deals slated for today. But Kunal, hi afternoon. What trends are you picking up? I mean, it's a lively, broader market. One doesn't really have to look at the Nifty today.
Well, absolutely. Yes, Aisha. Good afternoon. We were discussing this in the morning that a further drop in the India VIX could, let the index remain more into a range, and that range could be a lot more narrower than what we've been seeing over the last couple of days. So, example, yesterday we saw almost like a 300-point drop on the Nifty from the intraday highs. The Bank Nifty fell by 600 points. Today, the range is almost like a 100-point range for the index. And broadly, I think we are just holding on to that 24,500 mark. The best part which I like about the markets so far is the propensity of many of the stocks, even on the back of negative news flow. These stocks have seen a good recovery. Case in point, for example, metal stocks over the last couple of days, started this week, there was a slew of negative news flow for many of these metal names. These stocks have, more or less managed to absorb that kind of selling pressure, and many of these stocks have actually made a good comeback. And same is the case with, other individual sectors as well as individual stocks, which means that, this indicates that the markets are more or less likely to continue to remain into this band of 300 to 400 points. I strongly believe that US markets are on the verge of a potential much more bigger breakout. If that happens, then I think our markets could also end this phase of a consolidation.
Okay, Kunal, hold that thought. Let's take it across to my colleague Prakash, who's waiting by, because we understand that the government's PSU stake monetization will go on as planned. At least this is what sources are telling us. And merchant bankers and transaction advisors have almost been appointed as well, with the government looking to offload stake in at least 2 insurance companies. Prakash Priyadashi is waiting by with exclusive details on this. Prakash.
Yes, an important development coming in as we're learning from our sources that the government will move ahead with diluting its stake in PSBs and financial institutions as per the plan. We're given to understand that the empanelment process of merchant bankers and transaction advisors has been completed. In fact, the engagement of selected bankers for a specific transaction will be valid for 2 years. Along with that, the sources are also suggesting that the plans are in place to dilute at least 5% government stake in PSBs and insurance firms by end of financial year 2026. A very significant development coming in. Along with that, the deadline to meet minimum public shareholding could be extended beyond August 2026. That could be extended by another year based on the market conditions. Along with that, as you are aware that the government has already approved rupees 10,000 crore fundraising plans by 5 PSBs. Some PSBs have in fact initiated the process. The sources are also indicating that it intends to dilute a stake in at least 2 insurance companies in FY26, including LIC in phases.
Okay, PSU stake monetization, and that's what the ET9 exclusive is. But Dipan, other than the defense and railway pack, like we were just highlighting earlier, what else is looking good within PSUs, if anything at all?
Banks, I think across the board, PSU banks did exceptionally well. I don't think markets have recognized that. I think a lot of the PSU banks now, their financials, their quantitative parameters are in sync with or rather aligned to what we are seeing in the private sector as well, be it NPAs or growth in the balance sheet size. And also, I think they have worked on their client servicing technology platform as well. Yet valuations are pretty reasonable or attractive. And as we enter into higher liquidity, lower interest rates, I think the banking sector should do well, and PSU banks should outperform in terms of better earnings, and there's little bit scope for even the Ps to get re-rated higher. So within the PSU pack banks, I think kind of bit ignored at this point of time, but they also displayed a very good set of numbers for the March quarter.
So that's your take on PSU banks. But Dipan, before we let you go, also want your take on the entire insurance space, because that's also something that the news flow was pointing towards. What's your take on the entire insurance space? Because life insurance, general insurance, we've seen rather mixed moves coming in over the last couple of months. So where do you believe this sector is headed from here on?
I think from a long-term investor's perspective, we are avoiding insurance. Insurance companies have been around for almost 10 years now, plus private insurance. LIC came much later, but they haven't really, set the markets on fire. It's a highly regulated industry, and growth rates, I think, are pretty much tepid, I would say. High degree of competition, low flexibility in terms of innovation, and they've not been great wealth creators, nor have delivered fabulous returns as well. So from our perspective, we are avoiding all insurance companies. They're anyway very, very difficult to understand, track, and value. You cannot value them on traditional parameters like price to earnings, price to book. You have to go into the net asset value to the market capitalization. And there's a great deal of volatility in their other parameters like value of new business and insurance premium and persistency rates and so on and so forth. So it's a highly complex sector. But if it was giving good returns, beating the Sensex Nifty by a margin, then it would be worth the effort of studying these companies. But doesn't seem to be so. So from our perspective, the entire sector is a avoid.
A complete avoid coming in for insurance. It's been quite a disappointing performance in any case. But Dipan, good to have you on the show. Thanks for your time as always. We're going to take a very quick break on that note, come right back. We'll continue tracking the markets and the last half an hour of trade this afternoon.